MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. I always enjoy Fridays with you and our listening audience.
Our review of what's good and what's bad out there financially. Bob, I guess on the positive side, and if you're a stockbroker, it couldn't be better. We've had a record quarter in the stock market, something we haven't seen for a long time. Tell us about it.
Yeah, the headline I got here, best quarter in 10 years. Then we got another year on junk bonds, who's having the best start to a year since 2003. And then the triple B rated bonds, which are investment grade, they're doing their best since 1995. You know, this is a very good rebound in this quarter out of a rather frightening hit into Christmas, which, you know, recall that was our outside possibility that a liquidity problem could be discovered in the fall. And if it was hit, then it may last as long as Christmas, and that's what happened. And then we were looking for a rebound out until around March was our first target. And that would be accompanied by improving industrial commodity prices. Yeah, we had a pretty good rally out of the base metals, and an even better rally out of crude oil, which is still staying firm. But when you look for March, there's a lot of seasonal things can happen in March. We knew, of course, you can often have seasonal lows for crude oil in December, January, and I think it was the December 26th piece we put out noting that the stock market and crude oil were both technically very oversold. We had a sequential buy on them. So then you say, okay, what's the next probability? Well, March, and we're here, and it's been very good. But remember last year we talked about our friends of the bull market, and they would likely to be positive into around mid-year and then maybe falter. Whereas this year, what we call them friends of the rally, because the senior indexes are not making new highs, and we're getting pretty strong technical readings. Sentiment numbers are very positive, and this makes us a little concerned because if this energy now cannot get the senior stock indexes up to new highs, what's going to happen when it runs out of energy? So anything's possible in this kind of a market, but we just have to stay with our seasonal work and our historical work on the major moves, and then catch the swings when things are oversold, where you're down to a sequential buy, or when things get overbought and you're out to a sequential sell. So, you know, it's always a mystery, Jim, but we've had some good calls.
Well, Bob, you were telling us quite some time ago that getting into the quality bond market would be a good idea if you were worried about the markets. Was that a good move for people?
Yeah, there's been money made there. But now Well, actually, a couple of weeks ago, the long treasuries or long Government of Canada bonds got very overbought. And then you've also had that with corporate bonds, the investment grade, right down to triple Bs, and junk too. So you could say the whole bond market is overbought, and I would say kind of precariously overbought. The bond market can be very tricky, and I know that some people who are cautious on the bond market are concerned that maybe inflation's going to come back again. And I know any number of guys who specialize in commodities and precious metals are all there saying, oh, they owe us a big bull market in commodities. Market doesn't owe anybody anything. It just does what it does. But we have had a great financial boom, and it essentially concluded in 2018. You had a very hard hit to it, and then you'd have a natural rebound, which we've had. So the whole thing lies in, can the bulls take the stock market to new highs? Oh, I don't think so. A lot of power was expended in making the highs in 2018, and a fair amount of energy is going into making them at lower highs now. But this stuff integrates. You've got the stock market, you've got the credit markets where the yield curve, and which is the difference between long and short-term maturities, and then you got credit spreads, which is the quality stuff. And throughout all of the history of the Federal Reserve, when the credit markets get overdone and reverse, and we can call it reversing to adversity, the Fed has never been able to do anything about it because there's been 18 recessions since the Fed started business in 1914. So here we are. The moves in the credit markets in the last few weeks are indicating the party's going to, maybe the best of the party in for this is in. And so what we're looking at now, Jim, is what's going on in the yield curve and credit spreads. Also, the three short-dated bills, the 6-month Treasury bill, of course, was down to almost zero in 2009 crash, and then the interest rates go up in a boom, and they've gone up, and set a high in December, and then technically it looks like the 6-month bill yield has turned down. And this is important because our old observation has been that in a boom, such short-dated rates go up. And so long as they're going up, they're confirming that the boom is on. And then when they roll over and head down, that suggests the contraction. So this is, you can say that the short rates are no longer going up, and the 6 months maybe have started a trend to declining, and this then is a warning on speculation out there.
Now, our frequent guest, Sean Broderick, has an interesting theory, and of course there's no way to prove it, but he thinks one of the reasons why maybe the yield curve has inverted short term is that American companies that used to park their money overseas brought it home because of the tax breaks, and so they needed someplace to put that cash short term, so perhaps it's not the usual predictor of bad times ahead. Any thoughts on that?
Yeah, I saw another headline here saying that, the inverted curve, that it may be different this time, but overall I think, Jim, that the curve inverts because as speculators get active and leverage up, it increases the demand for short-term funds. That then pushes short-term rates up. then also in a financial boom, you've got people buying the long end and eager to reach for any yield. So that then puts long rates down, so you end up with an inverted yield curve. And I wouldn't try and explain it as being different this time, because what happened, yes, a lot of corporate money came back home to the U.S., but a good part of it went into buying their own stocks, which is financial engineering and is highly speculative. So I'm going to stay with my old view that when the yield curve changes, it's showing a change in character of the markets. And of course, the declining T-bill yield is part of that. But just looking at the T-bill on its own, it had its high with the 1929 boom in May, and then by July it was noticeably declining, and that was then signaling that the boom was more or less over. The Fed, for whatever reason, raised the discount rate in August of 1929. But then when the contraction started early October, they lowered the rate. So they followed what was going on in the markets. This is the important thing, that when you're talking about spreads and the curve and even just the T-bill, that's market rates of interest. And what the Fed does is the administered rate. Fed funds used to be called the discount rate, that sort of stuff. And at a market like this, we've been fully expecting that the T-bill rate would turn down at some time and been watching for it. Then a number of months later, the Federal Reserve would find a reason for dropping its rate. So the senior central bank over history has followed important changes in the market rates of interest.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Kelly Jennings, CEO of Powerband Solutions. Powerband is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWBF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Welcome back. We're speaking with Bob Hoye. Bob, has this been a good time for IPOs, initial public offerings?
Oh, that was the one I wanted to talk about, yeah. We used to call them new issue markets, where companies come to market with a new issue. And in certainly the last, 30 or 40 years, they've changed it to initial public offering. And the stock market is eager for news stories. And the way the markets work, you can really invent some good news stories. And even in the first great bubble in 1720, the lead company was a quasi-government company, the South Sea Company, and it was involved in raising money and helping the government out with its terribly depressed debt condition. And then, so it had to exercise a lot of options and stuff like that to keep funding the government. And then the whole thing became magic, and everybody was coming up with new issues. There was a new way to make sailcloth. There was new this, new that, new way to make beer. So anyways, suddenly there was a whole lot of new issues coming out, and the government could see that it was taking money from their main game, the South Sea Company. So they came in with the, you like call it the Anti-Bubble Act, that no more bubble stocks could be floated. But I think something like 400 on that boom was done. But they were right because it was taking money away from the main game. And here we have this now where a huge boom in new issues, and that takes money out of the liquid side of the stock market and puts it into the corporate treasury, where, it's eventually will do something constructive. But at any rate, it sort of might be putting a little bit of a gap into the markets here where tradable money has suddenly become parked money and may not be there for bids on the next set of nervousness in the market. But we could wrap it up on this one, Jim, by saying that new issues, initial public offerings, IPOs, are a sign of a peaking market when they really start coming out, which they have been. There's been quite a few headlines about exciting new issues and things like that. So it's a sign of a highly speculative stock market, and we're watching that one closely as well. But one of the things you find in a financial boom is remember reading years ago the Austrian School of Economics. Von Mises was the leading thinker there, and it's a very nice, tidy little statement, is that at the peak of a boom, that the contraction is not necessarily forced by the bankers calling in loans. Mises pointed out that all the bankers need to do is get a little concerned and stop making them, because credit is the lifeblood of a speculative market. So then I saw one here that here it is. A whipsaw stock market led to a general freeze-up in multiple areas of corporate lending and borrowing. So that's, it's a lengthy headline. It is essentially saying that people are getting a little nervous and slowing down on lending the money. So this one is worth watching as well. So, but I like that statement, Jim, that the bankers don't have to call loans to end the boom. All they have to do is get a little concerned and stop making them. And this is perhaps maybe started. I think it's inevitable. And we also know that after mid-year, you get a seasonal change. The old sell in May and go away. And then how many times do you see a depressed market in the fall of the year? Well, quite often. So there's built-in seasonalities there that I'm not going to defy. And for example, matter of fact, on financial pressures being discovered in the fall, the earliest one I found was in the Italian money market in northern Italy, Florence, place like that. Then they had quite a large market for mortgages, and they were trading, and then there was a big boom, and then it started to go bad. And it might have taken a few years for that catastrophe to work out, and there's a very good book on it, very detailed by a historian, an Italian guy named Cipolla. And the heavy pressures, the worst parts of the crisis, and this was in 1346, 1347, the worst parts of the crisis were in the fall. So there's something very seasonal in human nature when it comes to financial markets. So sell in May, go away, and then buy them back in the fall is a pretty good recipe.
We'll have more with Bob Hoye right after the break.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, there used to be a time in real estate nothing could be more comfortable than affording a $3 or $4 million suite in the Dakota in downtown Manhattan. Would that be the case anymore?
Whoa, no, that was your prime residential building in Manhattan, and hey, prices go up, prices go down. It's happened before in 1920 boom. The big mania peaked and focused on Florida real estate in 1926, and mind you, that was brought to a terrible end because it was a very bad hurricane. But the real estate going up in a financial boom has been the case, and then it heads down. And using Manhattan as an example, the sales are dropping, and that's the number of units being sold, and the prices are weaker as well. So, and I think somewhere soon you'll maybe find in California that suddenly it's a no-bid market for residential real estate. These markets are very relentless, and it's amazing to watch, but you always have a new set of players to get very enthused about things. And I know in the brokerage business, as it expands on a long bull market, you have more and more new customers, and then you also have more and more new brokers. So new customers and new brokers really don't have much in the way of experience and have a tendency to get too long at too high a time and stay there for too long, and then they learn about Mr. Market and also Mr. Margin. So, gosh, it never changes over all of the centuries. I mean, you even got a quote by Cicero back in early Rome, a writer well known, and he pointed out, and I can't remember the exact sentences, but anyways, the gist of it was that if you had a financial problem in the Eastern Mediterranean, a setback there where there had been too much speculation and too much borrowing, too much mortgages, that it would feed back into the financial capital in Rome. So he observed that, 1,700 years ago or so. And it's been the case since that now the concern of a few weeks ago was suddenly the Turkish central bank was running out of reserves, which is mainly the U.S. dollar, and their interest rates soared up to some huge number, 600% or something like that. So that is a serious hit to a fairly important Mediterranean country. And again, we've seen this even in my lifetime, whereby you have a problem in an outlying financial market, that it will inevitably come back into the main financial markets, which basically are New York and London. So in the Asian crisis in 1997, I remember it was July 1st, when Thailand central bank suddenly discovered its U.S. reserves were gone, and there was a panic in that market. And then, of course, the financial media said that, oh, this is just isolated to Thailand. It's their currency problem. And then in a week or so, it hit the Philippines, and then the same thing. Oh, it's just it can be contained. And then in 1997, then it got to New York in that September, when it suffered the worst monthly drop in corporate bonds in, I don't know, a decade or something like that. It's hard to remember. But at any rate, if there's a problem in Turkey, it won't be fixed when you've had such a fabulous speculation going on. And the only question is how it hits further damage to Turkey, and then how long it takes for that financial pressure to then hit Europe, London, and New York, and Toronto. Hey, we might just throw in Vancouver as well. But the end of it all, Jim, is that eventually we will end up with a very good bull market for gold and gold stocks. And I don't think we've left enough room to really go into those. But the probability is we are in the early stages of a long bull market for gold stocks, and one has to be very careful in getting a position on them.
What about curves and credit markets? Any word on that?
Yeah, this is looking timely, Jim. The party's been very good. So this week I've been working on a major study on interest rates, short end, long end, the curve, and credit spreads. And there is a building change here. I think we're out to about 6 pages on this, with charts and all that sort of stuff. And we'll probably have it ready next week. And we've done one like this in September 2007, that sort of thing. So it could be a very important piece.
Bob, thank you so much for chatting with us.
Hey, good to be with you, and let's look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.